Good evening, good afternoon, and good morning. Welcome to the Asia School of Business and SEACEN webinar series on macroeconomics, finance, and emerging markets. I'm Eli Remolona, Professor of Finance at the Asia School of Business, where we have a Master of Central Banking program, one that's focused obsessively on central banking. And I know that SEACEN has its own great courses coming up. Tonight, of course, we're in for a treat. We have Atif Mian of Princeton, who will talk about what we know and what we don't know about capital flows to emerging markets. He will be introduced by Ozer Karagadekli. But before that, let me mention two webinars that are coming up. October 21 at 6 p.m., we have Glenn Stevens of the Reserve Bank, former governor of the Reserve Bank of Australia, and Athanasios Orphanides, former governor of the Central Bank of Cyprus. They will talk about bloated central bank balance sheets. At 6 p.m., October 21. November 26, we have Debbie Lucas of MIT Sloan. She will talk about monetization. Now let me turn to Ozer Karagadekli, who will introduce our guest speaker. Ozer?
Thank you very much, Eli. It is my great pleasure, everyone, to introduce Atif Mian of Princeton University. By the way, for that conflicting pronunciation of Atif's surname, I've checked that mine is correct, Eli. The N is meant to be silenced, but anyway, but that's not the main thing for tonight. We are really, really pleased to have Atif Mian here tonight with us. A couple of things about him. Of course, he doesn't need introduction. He is a household name to tonight's audience. But Atif is John Laporte Junior Class of 1967 Professor of Economics, Public Policy and Finance at Princeton University. And he has been there since 2012. Previously, he taught at Chicago Booth and UC Berkeley. Atif holds a bachelor's degree in maths with computer science at MIT and also a PhD from MIT. His work studies the connection between finance and macro, and they have been published in various academic journals. And he is also the author, co-author of this critically acclaimed book, The House of Debt, that he co-authored with Amir Sufi of Chicago Booth. I guess one of the most important things that comes in that book and maybe further other work of them is that they point out that traditional debt contracts force borrowers who can least afford those risks to bear the most of the risk in the face of macro shocks, and they ask for rethinking about role of risk sharing that comes very strongly in that book. And that's all from me. Without further ado, Atif, thank you very much for joining us tonight. The floor is yours, and we'll be conveying questions to you time to time.
Thank you, Ali and Ozer, for having me. It's a pleasure to be speaking to all of you. If someone can just give me access to share screen.
I am trying to, yes, now. Here we go.
So I'm going to be talking about central banking policy in emerging markets, particularly in the context of a globalized financial world. And let me preface my talk by just clarifying what I mean by central bank policy choices. And I'm going to take an expansive view of what central banks do. The details, of course, differ across countries. There may be some other institutions that take some of the policies listed here, but whenever I talk about central bank policy, it's going to be inclusive of all the policy tools that you see on the slide. So it includes monetary policy, which everywhere, of course, central banks are supposed to directly have a hand in. But I'm also going to include within the purview of central bank policies, exchange rate policies, capital controls, and equally importantly, the role of macroprudential policy. So think of this holistic picture of all of these policies put together, and I want to ask the very important question of how should these tools be used, how should these policies be designed in emerging markets. I'll go through the details in a minute, but let me just say up front that there's a lot that we have learned over the years, especially over the last 20 years or so, given all of the empirical work and then the conceptual framework behind it. I feel there's a lot of clarity on this issue that was not available beforehand. However, that clarity is not necessarily being implemented all the time or in places where it really deserves to be. And so I hope that as we go through the talk, I'll be able to clarify some of those issues that need to be taken into account, especially in emerging markets as they design central bank policy. So let me, I'm going to keep the talk at a very high level, not going to go into any sort of technical details, but I would love to, if in case there are any questions from the audience. So while I will just keep things at a very conversational level, if you have any questions about the theoretical or empirical underpinnings of anything that I say, please let us know over chat or Q&A, and I'm sure Ozer will relay your questions to me. So I'm going to, because we are talking about emerging markets, I'm just going to start with picking 3 examples. I'm going to pick one country from Latin America, I'm going to pick one country from Asia, and then I'll pick one country from Europe or Eastern Europe in particular, and talk about their recent episodes, which in many ways are quite characteristic of what we know from a broader study of emerging markets over the last 40, 50 years. So the first case study I'm going to talk about is one of Brazil. And first, you can see in the picture on your left that Brazil went through a significant credit boom during the 2000s. And in particular, that credit boom was concentrated in household debt. So you can see in this picture that there is a significant rise in household debt to GDP starting from around 2005, 2006, and really takes off from 2008-9 onwards until 2011, basically. And actually up till 2014, to be more precise. And as a lot of you must know, this big boom in household credit was then followed by one of the most severe recessions in Brazil, starting around 2014, 2015, and for a couple of years especially, Brazil had a very serious recession. Now, what I want to talk a little bit about is what was happening during this credit boom that you see on the left. And a couple of things are worth mentioning. The first one is that during this time, there were a number of very explicit policies implemented by the government. And as in many countries, there are a few government banks also that are very dominant in Brazil. So partly through those banks and partly through credit policy and banking regulatory policy overall, Brazil encouraged household and consumer lending. This was done through a number of different policies. One of them encouraged payroll lending, for example. Another one changed laws that made it easier for creditors to, grab collateral and as a result to lend to people. And then perhaps one of the more important ones during this period was a big housing scheme that was for low-income individuals that was started in Brazil. But an important element of that housing scheme was that it promoted credit as a way for accessing housing for middle and lower middle income people. So the end result of all of these policies was that you saw this this very rapid credit growth. And the other thing to keep in mind is that while the country was in the throes of this credit growth, the economy seemed to be doing fine. I mean, some of you might remember Brazil was supposed to be a big success story from the emerging markets during this time period. And along with that, what I want to focus on next is the figure on the right. Because what I want to highlight here is that while the headline numbers might look quite decent for Brazil during this credit boom period, there was a particular bias in that growth process. And it's that bias that I want to highlight, because I'll keep coming back to it as I go through the other examples. And the bias that you see in the figure on the right is in terms of the growth being disproportionate in the non-tradable sector. So here you can see this is explicitly plotting employment in the non-tradable sector over the tradable sector, and you can see that the relative size of the non-tradable sector continued to expand during this big credit boom period in Brazil, and it took the recession to really for that trend to taper off. And so this is something we want to keep at the back of our minds: growth in consumer or household credit, growth in relative growth in the non-tradable sector, and then followed by a serious slowdown, in this case, a serious recession in the country. So that's sort of case study number one. I want to next talk about an example from Asia that I'm personally quite familiar with, being from Pakistan myself. So in this case, now I'm going to focus on the 5-year period of the previous ruling government, which was the government of Prime Minister Nawaz Sharif, from 2013 to 2018. And what is interesting about this particular period, and you can see this very clearly in the two figures that I'm showing you. So I'll come back to the figure on the left, but what I want to first show you is the figure on the right. And there, the red line, as you can see, is plotting real exchange rate. Now, real exchange rate, very quickly, as many of you know, real exchange rate is supposed to measure the true purchasing power in goods terms of a country's exchange rate level, and it is supposed to not move around too much, because you want to keep, in terms of your real purchasing power, you want stability in the real purchasing power, and you want the nominal exchange rate to absorb any of the shocks that the country might be receiving. But what is very interesting in Pakistan's case is that from 2013 to 2018 period, that's where this red line really is appreciably rising. And in fact, you can see that from trough to peak, it goes up by around 25–30%. And that's a very large increase in real exchange rate, in exchange rate appreciation. So you can see the real exchange rate appreciating quite a bit, by 25–30 percentage points. What I want to illustrate is that real exchange rate appreciation was not an accident, and it was very much driven by some of the policy choices that were implemented in the country. Again, as I said in the beginning, my point in giving these examples is to illustrate that there is a lot that goes on in emerging markets in terms of policy, active decisions and choices being made, which do not turn out that well. And in fact, there is a systematic reason that they don't, and that's the key lesson I'm going to come back to once I go through these early examples. So why is the exchange rate going through this appreciation wave? Well, the reason is that the government adopts a very active policy of promoting large construction infrastructure projects in the country, but driven by external borrowing by and large. And this is the period when China also becomes very important, but there are some other countries who are lending to Pakistan as well. But the big player during this time is China through CPEC. And so Pakistan undergoes this sort of, the initiation of these large scale projects. And as is often the case, it pulls in a lot of private sector spending, especially in the housing and construction sectors. And all of that reliance on external financing, as well as this focus on construction and to a large extent the non-tradable sector, all of that has some immediate implications for the country. I've already shown you one, which is the real exchange rate appreciates. But along the same lines, just like I showed you in the case of Brazil, the tradable sector slows down. In fact, it literally grinds to a halt. And you can see that in the figure on the left, where I'm plotting the growth in exports in just nominal dollar terms. So this is not even accounting for inflation or anything. And what is remarkable is that even in nominal terms, Pakistan's exports essentially grind to a halt during this time period. In fact, there is, they even dip a little bit during this time period. This is quite remarkable for a country which is at the level of development of Pakistan, which otherwise you would be expecting to, growing quite a bit, especially in the export sector, also with population growth and all of that. And again, this is in nominal terms. And despite all of those expectations, the country actually has a very serious slowdown in the tradable sector, in exports in particular. And despite that, the government continued with this very active policy of pulling in more credit from the outside and keeping the exchange rate at this elevated level that I've talked about. And again, so you see a credit boom, in this case an external finance credit boom, and you see a expansion in the non-tradable sector and a complete collapse in this case of the tradable sector. So again, those are the similarities with the Brazil example that I talked about, and again, driven by some very active policy decisions. The exact nature of those decisions is different in Pakistan during this regime, but there are obvious similarities. And this was, of course, followed by a huge balance of payment crisis. So this red line that you see in the figure on the right is showing you the massive nominal exchange rate depreciation that had to happen in 2018 because of all of these imbalances that have been built up over time. And it only is a result of that depreciation that real exchange rate finally goes back to its long run level. But a lot of damage has been done by that time. Now, I don't have time to talk more about Pakistan, but what is very interesting is that since 2018, it has had a new government, of course, under the leadership of Prime Minister Imran Khan. And what is interesting about this particular regime is that while it is not repeating the mistake of the Nawaz Sharif government, it seems so far that it has chosen to adopt the mistakes of Brazil quite explicitly and quite aggressively. So since the new government came about, while it sort of, rationalized the external sector, there has been a lot of emphasis on delivering growth through growth in credit in the housing and household sector. It hasn't actually taken off because the government is facing some institutional hurdles and legal hurdles in the ease with which people can sort of expand in the housing sector. But what is very interesting is that from day one, the government is kind of trying to implement a Brazilian style push in domestic credit focused on the housing sector in sort of, the NEA housing scheme as it is called being the prime example. And of course, that tells us that even now in this new regime, Pakistan is not sort of following some of the key lessons that have been learned over time, and especially in the case of Brazil, as I just talked about. So this was the second example I wanted to mentioned. And the third one, as I said, I'll pick from Europe, and this is the case of Hungary. What you're seeing in the picture on the left is once again a picture that looks very similar to the one for Brazil that I showed you, which is a very rapid and significant rise in household debt to GDP over the period of 2000s. This is before the global recession, with one additional twist. So like Brazil, the government first sort of facilitated expansion in household credit by subsidizing local currency loans in their local currency, which is florin. However, in the middle of that process, they liberalized the sector in one other way as well, which is they allowed foreign banks, primarily Austrian banks, to not just operate in Hungary in the domestic sort of household sector, but they also allowed those banks to lend in other currencies, and euro in particular. So there was a lot of euro lending denominated in euros, loans given to the household sector. And because, for kind of understandable reasons, the interest rates, the nominal interest rate, or the spot interest rate, I should say, were much significantly lower than the local currency interest rate. People kind of felt that it's cheaper to take on those loans. As you'll see, they turned out to be wrong, but they perhaps did not forecast or foresee potential troubles ahead. So they just looked at the spot interest rate and said, okay, this seems cheaper, and they went with the foreign currency denominated loan. So from around 2004 onwards, you can see that this green line tapers off, which is the lending in local currency, and the red line really keeps the momentum going. And so there is a lot of lending in the household sector, which is denominated in euros in Hungary throughout this time period. Now, for a while, just like in the case of Brazil, while all of this credit boom is happening, apparently there is no problem. You know, the economy is not in a crisis. You're seeing growth. You're seeing healthy demand in the economy, and the exchange rate is kind of stable because all of this money continues to roll in, so to speak, and so there does not seem to be any apparent problem. But of course, the right philosophy for central bank policy in emerging markets, or in any country for that matter, is that you look ahead for potential contingencies. And this was again the key problem with this particular policy being followed, that once the 2008 recession happened, there was a complete kind of a sudden collapse in the flows of this international capital flows into Hungary, and as a result of that, there was a massive devaluation of the local currency, because people now worried all of a sudden, how will the household sector in particular pay back all of these liabilities that are denominated in a very hard currency from their perspective. And people question that, and whenever you question a country's ability to pay back in international markets, the currency depreciates a lot. However, in this case, the depreciation of the country, the idea of depreciation is that it's supposed to help the country from cushioning these shocks, because by devaluing, you make yourselves more competitive. But unfortunately, given the policy choices that were made in Hungary in the past, this devaluation, rather than helping, actually made the problem worse along certain dimensions. And that piece you can see in the figure on the right, that shows you that when this massive devaluation happened, areas of the country that had taken on these foreign currency loans with a higher ratio, higher or disproportionately so, they suffered a lot more in the form of a stronger slowdown in the local economy and in the form of a higher rise in unemployment in those local economies. And the reason for that was that people who had borrowed in foreign currency, when exchange rate devalued, the real value of the liabilities did not change at all. And so for them, since their earnings are in local currency florins, while their liabilities are the same, the real burden of debt essentially increased significantly. So this was it turned out that this was a classic example of what is called Irving Fisher's debt deflation hypothesis. And as a result of that, there was a serious contraction in demand, and you saw a much more significant recession in Hungary than would have been the case if some of these bad policy choices were not made in Hungary. Okay, so I am going to
a question
stop here, and before going to the sort of the broad picture, go back to Ozer in case there are any questions.
There's a question from Ollie Rommel. Ollie asks whether, there's something in the boom that made the country attractive to foreign loans. Is this kind of like the Dutch disease? There's something, or Ollie calls it Dutch disease redux. Is there a similarity?
That's exactly, absolutely. That is exactly correct. Conceptually, the way to think of what is going on here is, one of the core problems here is precisely what is termed as Dutch disease in this international literature. So, for other people on the call, Dutch disease, the idea there is that in this context, a boom in credit disproportionately raises the price in certain sectors, and as a result makes some of the other sectors perhaps less appealing for investment and so on. And in this case, that is the tradable sector. So because this credit is biased towards the household sector, that's why I've been flagging this throughout. This credit is leading to a stronger rise in the non-tradable sector. And as a result of that, your wages are rising, right? Just think of that example. Your local wages are rising because there is more demand in the housing, in the construction sector. People are spending more. So there is just this broader expansion in the retail sector. All of those examples are non-tradable sectors. So there is this boom in this non-credit driven, non-tradable sector. And quite naturally, as a result of that, more labor is pulled into the non-tradable sector. So more labor is pulled into the non-tradable sector. Number two, because of this credit boom, their wages rise in the short run as well. But this is what leads to Dutch disease. Because as labor in all of these examples, Pakistan, Brazil, Hungary, as labor becomes more expensive because of stronger labor demand in the non-tradable sector, the important sector that starts to suffer is the tradable sector. Because all of this demand, or most of this demand, is concentrated locally within those countries, because that's where the credit growth is. But the tradable sector, by and large, or by construction, I should say, by definition, does not depend on local demand. Export sector depends on global demand. So their demand is not positively affected during the credit boom, but their cost goes up during this credit boom because of higher wages through the process I just described. And so that is the important reason why we see this relative growth in the non-tradable sector, or equivalently this slowdown in the tradable sector. For example, in the example of Pakistan. So Pakistan is the classic case of Dutch disease over this 2013-2018 period that I just mentioned. The other problem is that the follow-up of this Dutch disease is that once this credit recedes, once this positive demand shock fades away and turns into a negative demand shock for the economy, it's very hard for the export sector to pick up right away for kind of obvious reasons, especially in the export sector, which, by the way, is a more productive sector by and large. An important element of maintaining productivity growth in the tradable sector is what people refer to as learning by doing. You have to continue being at the sort of the top of your game, so to speak. But these Dutch disease style forces that we just talked about, they make it harder for the tradable sector to continue to grow and to continue to learn by doing. And as a result, when the big negative shock hits, it becomes actually difficult for the country to just turn on the switch and now all of a sudden move in the direction of rapid export growth. The point of all of this conversation is that for a forward-looking policymaker, all of these problems need to be incorporated upfront. And we need to have a forward-looking framework within which these various policy choices that I mentioned in the very beginning, those policy choices are decided and designed. So now let me move to that broader perspective. In case if there are any other questions, I'm happy to take them as well. So let me now turn to those broader lessons. Through the example that I've given you, it's quite clear what those examples mean. But the next thing I want to sort of mention is that I wasn't picking these examples just to make a specific point. The patterns that I just showed you are very systematic in the data. They're very broad-based. And so for those of you who are interested in digging into that further, there are a couple of papers that I'm citing here on the slide that you can go and look into. But again, this broader message of household or consumption-driven credit growth having poor consequences, leading to bad outcomes for the economy, it's a pattern that you see time and time again. And in fact, it's not even only an emerging market phenomena. You see it across the board. You see it very much in advanced countries as well. You know, some famous examples being US in 2008, you know, Greece, Spain, and many others. So it's really a broad phenomena. And whenever you see an empirically repetitive broad phenomena, it is telling you that there is an important common conceptual reason behind it that is leading to all of that. And that common conceptual reason is the one I just talked about, which is that reliance on, let me just use this word, excessive household or consumption-driven credit leads to this, again, the Dutch disease phenomena that we talked about, this growth in non-tradable sector, and all of that, for reasons I've already talked about, has bad consequences. And again, one of the reasons for the bad consequences is that when the positive euphoria goes away, there are naturally a number of nominal frictions in the economy that prevent you from adjusting as quickly in the right direction as you would otherwise want to do. So for example, nominal frictions like, you know, downward wage rigidity, or structural issues like it's difficult for labor to transfer from the non-tradable to the tradable sector at the flip of a coin, and things of that nature. Frictions of that nature make the adjustment process very difficult. And so you have to go through a sustained period of pain before you can recover once again. And so that's where the policymaker comes in. The policymaker needs to be forward-looking. They need to have the wisdom to incorporate these possibilities and design a framework that prevents this sort of stuff from happening. So what does that mean? Conventional wisdom, a country, especially emerging markets, should have flexible exchange rate because it allows you to absorb shocks. It allows you to buffer shocks. Another conventional wisdom, what is referred to as avoid the original sin, which is, unlike Hungary, you should try to only borrow in your own local currency, or unlike Pakistan, in the other example, you should try to borrow in your own local currency. Both of those broader lessons are absolutely legitimate. You can look at the data carefully, and these boom-bust cycles that I talked about, you can see very clearly that if you have a flexible exchange rate, it helps you to cushion some of the downside. Doesn't take it away completely. I want to be very clear on that. I'll come to that in a minute. But it does help on the margin to have flexible exchange rate. Similarly, avoiding borrowing in a hard foreign currency clearly helps in the data. These boom-bust cycles have less of a pain associated to them if you are not borrowing in a foreign currency. However, neither of those two conventional wisdoms is sufficient for you to avoid the problems that I talked about. So while you definitely want to keep them front and center, and as I've already given examples, policy makers still time and time again seem to forget this message. But I want to be sort of clear on one point, which is it's not as much policymakers making active mistakes. A lot of the times when you look at what is happening kind of behind these big trends, there's a lot of kind of the usual myopic political pressure that is forcing policymakers' hand, and in some cases, to go in this more irresponsible direction, because in the short run, this credit boom can help juice the economy. And politicians, being, short-sighted at times, they rather go for that than sort of look for the long run, look for sustained structural growth. And so that insight makes it very important, the idea of institutional strength. So I want to be very clear that when I talk about good policies, it's not just like a menu that you just have to pick the right set of policies. And it's not like we can pretend that you can always pick the right kind of policies because you always have that choice and you always have that discretion, especially in these emerging markets, but increasingly in countries like the US as well. Policymakers are in a very difficult position. They have to withstand a lot of political pressure that is pushing them in the wrong direction and so on. And so we need to also advocate for serious institutional reforms that give policymakers space and discretion to, at least to some extent, to sort of push back on those political pressures and those, political sort of myopic pressures that might come about. And at the same time, you want to strengthen the institutions and you want to appoint people of the right caliber, right? So I think those two things are actually very important. You want to give discretion, but at the same time, you want to marry discretion with competence. And obviously that's where as they say, the devil is in the details. I mean, that's the tough nut to crack in my view. But countries that are able to solve that problem to a larger extent, those are the countries that can really tackle these issues in the long run. So this is an important point to keep in mind as we walk through the policy space. But let me come back to now the policy menu and talk about sort of what else needs to be done on the policy front. And from now on, I'm just going to assume that you have some institutional bandwidth to move in that direction. I should say, by the way, on that, and just this is more my anecdotal personal experience rather than sort of a scientific study, if you will, because it's hard to study these things at a broader level. My sense is that while it is true that there are political pressures which are short-term and myopic in nature, there still remains a gap, a communication gap, where perhaps I'll put the blame on people like myself, that we have not clearly and forcefully communicated these issues to the political high brass. Because obviously, for understandable reasons, politicians are not necessarily economists or macroeconomists or whatever. And I think there is a lot of confusion as well that needs to be clarified. So for someone who's not an economist, it might not seem like a wrong policy at all. Yeah, what's wrong with building 1 million houses, for example? Who can argue against giving credit or even free housing to a low and middle income population? That's where you need to have clearer thinking, and then you need to communicate that, look, there is this Dutch disease problem that can become really serious if you go about doing it the wrong way. And so while some problems are driven by sort of bad incentives, I think similarly there are problems that are driven by poor communication of these ideas to the policy side. So I hope that, especially obviously seminars of this sort and so on, that they help communicate these ideas to the political side as well. Okay, let's come back to the broader lessons. As I said, flexible exchange rate, avoiding the original sin, it helps, but it's not sufficient. So what additional tools do you need? Policy choices do you need? And I want to talk about two of them, and then I'll go into the details of how to design those. The first is that capital controls, and this is one area where I would fault the maybe the academic side as well, but certainly sort of the Washington consensus world. which allowed for completely open borders for capital. So you have complete capital account convertibility, for example. No notion of any capital controls. I think that it's very clear that that idea in the extreme is not correct. And while you certainly don't want to go to the other extreme, as this is an important life lesson and also applies to policy, extremes don't work. And so anytime you hear someone saying, it's either communism or it's like free markets to the nth degree in terms on the capital market side, both those extremes are clearly flawed in a major way. So we need to think of capital controls more seriously, and I'll talk about how to do that in a minute. And then the second dimension of policy choices, which is very important to add, is what is broadly referred to as a sound set of macroprudential policy tools. And again, I'll next talk about, let's put some more meat to this, these two policy choices of capital controls and macroprudential policy. So let's now be a bit more specific and design these policy choices, so to speak, in a little bit more detail. The first point I want to make is that it's not that there is one size that fits all. The right answer very much depends on where a country is in terms of its level of development, both economic development as well as development of its financial markets. But there are clearly some important lessons to follow. And let me just say parenthetically here that one country that has actually done reasonably, given the broader roadmap, it has done reasonably good in following these guidelines, perhaps explicitly or maybe implicitly, they got lucky, is China. And if you focus on China's choices of when they liberalize and how they liberalize, as you will see, it very much follows kind of this this prescription that I'm going to talk about. So what's important here? By the way, let me just say what I'm talking when I say the Chinese experience is flawed in one very important way, and I'll come to that at the very end. So there is one deep problem that China has, but some of these lessons they actually tended to follow over this period of 80s, 90s, and the early 2000s. Anyways, coming back to this broader lesson, what are the important policy choices to make? Well, the first thing to keep in mind front and center is that insurance and risk sharing matters. And I've already mentioned partly what that means. Flexible exchange rate, avoid borrowing in a foreign currency, both of those, and this is the broader lesson. So, there's many other things you can do from a macro-prudential regulatory framework that goes in the same direction. The direction being that risk sharing matters. So for example, let me give you some other examples. It's not only about flexible exchange rate and avoiding foreign currency. It also matters how you design your bankruptcy system. You want to make it possible for people in extreme hardship to be able to release themselves of the burden of debt, which is the idea of having bankruptcy court. So that element is also important, for example. Similarly, you may want to promote indexation of debt payback to certain macro variables like housing index, for example, or interest rate. So, think of adjustable versus fixed interest rate, certainly on the downside at least. So you may want to give those kind of institutional protections that promote insurance or risk sharing more broadly. We have learned time and time again that when we talk about these recessions and these big collapses and so on, especially driven for financial reasons, especially driven for capital market reasons, a lot of the time the common link is lack of risk sharing. Financial markets are or well-functioning financial markets, I should say, are supposed to promote risk sharing. They are supposed to be shock absorbers. But unfortunately, when designed the wrong way, rather than absorbing shocks, they can do the complete opposite, which is that they become the generators of financial and economic shocks. So we need to be very careful on those margins. And again, I've highlighted some of those dimensions that move in the direction of promoting risk sharing. Number two, policy should be designed to prioritize productive over non-productive credit. This is very important, and I would say this is one of the points that is perhaps least well understood. not all credit is created equal. This is very important aspect to keep in mind. In particular, there is a key distinction between what I would term as investment-driven credit. So credit that is financing real investments. So think of greenfield investments, property, plant, and equipment, things of that sort. Or could be these days intangible like R&D, investing in patents, things of that nature. All of that is good credit. All of that is good finance, if you will. And again, I'm not just, I'm an empiricist at heart. So there is, in the work I cited, you can look that up, and there is some evidence there as well. But this is sort of what the data tells us. What is the bad kind of credit is what I'm calling here the non-productive credit. And by and large, that is credit that is not investment driven, but instead it is what I would term as consumption driven. I just gave you a number of examples of that, all these booms in household credit, housing, construction, and so on. They are often essentially consumption driven credit booms. And that is, again, why they lead to Dutch disease, as we have already talked about. So you must prioritize what kind of credit you want and what kind of credit you want to discourage. And so it has natural implications. So let's go back to capital controls. We must prioritize capital controls. You should promote FDI. And now this is where when I was referring to China, this is in particular what I was referring to China for, that they did a good job on this particular margin. Again, they have serious problems elsewhere, but they did a good job on this particular margin. FDI is good, and we now have very good evidence that shows repetitively. You don't have the kind of problems I talked about if credit is coming in to, again, go into the right kind of FDI. The problem really comes about when it is going into so think of portfolio flows in general. They are not necessarily that advantageous. You must tie, another way of thinking about this is, it is costly, especially in an international context, especially given the original sin and things of that nature. The cost of international borrowing for emerging markets is always, I would say, higher than the number on the piece of paper, which is the interest rate. It's always higher from a macro perspective because adding external liabilities has all of these potential problems built into them. And so you must prioritize when you want to expose yourself to those external liabilities in particular. And as I said, the rule of thumb is promote FDI, but discourage the hot money flows, discourage flows in general that are largely financing spending and not investment, okay? And again, when you go through the details of what's going on, unfortunately, this lesson is not being learned. The other important point is that duration matters. So again, as many of you must know, it's the mismatch in duration that leads to a lot of financial imbalances in the short run, whenever there are runs and liquidity issues and things of that nature. So prioritize patience and patient capital over short-sightedness. So this once again goes in the same direction. FDI by definition is long-term in nature. You want credit, you want capital that comes in with other complementary factors associated with it. So it should come with technology. It should come with sort of transfer of skilled labor and transfer of technology into the local economy. And as I've already said, beware of the non-productive credit, which largely means beware of housing and credit miracles that sometimes are very appealing, especially from a political perspective. But we must understand that that's repetitively led to serious problems for the society, for the common person in those countries. And the bottom line really is quite simple, actually. Once you think of it, it's sort of obvious. And the important thing is we need to communicate that from a growth perspective, when you're designing policies, what matters is whether you are investing in your own people or not. Keep that front and center and you'll end up making the right decisions. In technical jargon, what that means is that the only thing fundamentally that matters in the long run is what we economists refer to as domestic productivity. And once you keep the focus on that as your ultimate objective, you tend to reduce the incidence of bad policy choices. So think about, let's go back to bad credit, like non-productive credit. think of borrowing, take a bad policy, you borrow externally to build a bunch of houses. Why is it bad? Well, the reason it is bad is that you're going to accumulate all of those liabilities, and you're investing in something that is not productive at all. It is not going to boost your productivity. If you build an extra house, that does not make it any easier for you to, boost your manufacturing capacity, for example, or raise your agriculture productivity. To do that, you need to invest in those sectors. You need to invest in R&D, you need to invest in better technology, better management skills, and things like that. Simply building houses, which is nothing but a final consumption good, is not going to boost your domestic productivity. So this is what I meant, once again, going back to prioritizing credit and prioritizing productive over non-productive credit. Once you think about it, it's a very, it's a very obvious choice. And yet, time and time again, as I try to give you examples, countries have gone the wrong way. So let me stop at this point in case there are any additional questions.
Atif, when you prioritize productive credit, or maybe prioritize FDI, what do you say to the politicians who wave the banner of nationalism, who don't want to give up control of companies? When FDI comes in, it often comes in with control of a company.
Yeah, that's a very interesting.
The locals usually don't like that.
Yeah, I think there's a middle ground here, I think, that can be followed, and we have seen examples of that, and again, China being one example of that. So this was very much what just highlighted was very much a concern of Chinese government as well. Let me just say one thing, which is that this concern, again, as I said, we should avoid extremes. And on that, I would say this concern has some legitimacy as well under certain scenarios. Let me give you one example. In fact, let me just give you the example of Korea, which is, a very strong country, of course, economically. But something very interesting happened in Korea before and after the East Asian crisis. What happened in Korea was that while crisis was severe in sort of the financial market context, the biggest change it made in the case of Korea was this change of ownership from Korean hands to foreign hands. Because, obviously they had problems repaying and so on. So international capital came in, but on this condition that you transfer control. Now, what that example illustrates for us is that there may be times when a country can be forced through fire sales of sorts. And that can lead to transfer of ownership at fire sale prices that can have longer term consequences in terms of technology transfer, in terms of balance of payment issues, and so on. So I think when we talk about foreign ownership, while we want to promote it for the right reasons, we also want to make sure that it is happening at the right price. That's the broader point I was trying to make here. And in many of these emerging markets, because of shallow markets, because of liquidity problems and all of those kind of issues, the price they may not get a competitive price for some of the FDI that's coming in. So I think one has to have a balanced approach towards FDI. And I will again push back against one extreme, which will be, okay, have completely open FDI that pays no attention to, how much someone is paying. And again, take the example of Russia. The privatization was an incredibly bad decision, not because privatization is bad, but because the prices were just completely wrong. You gave away enormous assets for peanuts, and that led to these oligarchs and created all kinds of problems. So I'm just basically trying to say that this is a much more nuanced problem, and you need to address all of the dimensions of this issue. But I'll come back to keeping the objective in mind. It is your own people's productivity that should come first. So in that sense, you do have a natural priority. Whichever country you're in, it is your job to first and foremost care about your people. So it's just a very, very natural thing. You want to make sure you're getting a good deal, right? And so I think that broader notion needs to be kept in mind. And then within that, you can design parameters. So for example, you can say that, right now we are very weak. If these international players come in, they might kind of grab stuff at fire sale prices. So given our weakness, we want to restrict when and how they come in. So you may prioritize sectors. You might say, well, we are going to open up sectors where technology transfer is most useful. So even if they pay a lower price, you want to actually give that as an incentive so they come and they invest in the right technology sectors. You may impose limits like, okay, you can buy up to X%, but make sure you have a local partner. Those kind of conditions, by the way, can be very important. So for example, saying that there is a technology transfer component to this FDI. I think those kind of restrictions, again, I completely am with you with the spirit of the question. The devil is always in the detail. But at least from a conceptual framework, we need to have this clarity of what we are after. And once you have that clarity, it becomes relatively easier to design how to go about achieving that.
If may I relay one of the questions, one quick comment and then question. The comment is when you talk about not all credit created equal. In the case of debt credit for housing, in fact, for the data, for the countries that we have data for, the credit for housing doesn't even usually go to the construction of new houses. It goes for the exchanges of existing houses, which something was very new to me. I mean, I think that's puzzling most of us. So that's just a comment. The question from Refet Gürkaynak, can you talk a bit about ex ante and ex post capital controls?
Yeah, so by the way, your comment is absolutely on the mark. I should have mentioned it actually, it's a very important point. And it's very much related to the Dutch disease argument. The reason this non-productive credit is bad, one of the reasons is that it leads to not as much real activity, but it just leads to appreciation of prices, essentially price of land, which obviously has always been there, will always remain there. Nobody is doing anything to create more land. And yet, if this credit boom is by and large leading to just an appreciation in the price of land effectively, it's not doing anyone any good. It's just making it more expensive to do the stuff that you really should be doing, like investing in productive export-driven commodities and so on. On the other question of ex ante versus ex post, this is, again, a very important and serious question. Let me broaden the scope of this, not just capital controls, but more broadly. There is this notion that a lot of these issues you can handle ex post. Let the crisis come, and we'll kind of clean up after the crisis. There's a problem with that approach, and the core problem with the ex post approach is one of commitment and credibility. When push comes to shove in the middle of a crisis, it becomes very difficult for the political authorities or policymaker to come in and, for example, say to the banks, well, here's your living will, you must restructure massively your balance sheet and you must write down the value of your bad debts and so on and take the losses on equity. It becomes much harder to do that ex post. So which is why I am of the view, and we talk about this in the book that was mentioned early on, that to the extent possible, policies should be designed where you deal with the problem ex ante, knowing full well that you don't know when problems are going to arise, and knowing full well that whenever they arise, you're going to be subject to this credibility or commitment problem of the sort that I just talked about. So I think it's much better to design policies that deal with these from an ex ante perspective. So then you already have in place, so I'll give you one example of that. So for example, on this risk sharing idea, it becomes much harder to try to ex post and sort of force losses on in the banking example on banks, as I tried to explain. It's much easier if you do it ex ante and you say, you know what, the simplest example would be you can finance X%, or you must finance X% through equity. That's an ex ante policy, because when you force people to finance X% through equity, equity by design is risk sharing in nature. So now you don't have to worry about ex post credibility problem, because the nature of the financial contract is such ex ante that it's going to automatically adjust given the problem at hand. And so I think overall we should always, maybe it should have been on the slides, that in terms of prioritizing, we should prioritize ex ante over ex post because of this credibility and commitment issue.
Atif, there's a question about the complacency of the elite. I think you kind of mentioned this already, but maybe you can talk about it some more. How do you get someone, a politician, when the country's having a good time, how do you get that guy to change course when everyone's having a good time?
Yeah, I think it's very difficult at that time. I think this sort of change, it's a very serious issue you raise, complacency, and sometimes it's much worse than that. I would say it's complacency / conspiracy, perhaps, of those who are benefiting from a flawed system, rent seeking and so on. It's a serious problem. It's a very major problem. And again, I've seen it firsthand in some examples. I think first of all, as people talk about crisis and opportunity, I think when countries go through a period of crisis, oftentimes that is a good time to just bring focus back on these and put those institutional things in place. So that's number one. It is more difficult for the obvious reasons that you mentioned to do that, to implement structural change when everything seems to be hunky-dory. But the other challenge, and this is the challenge, the ultimate challenge perhaps of nation building, which is how do you bring about consensus that keeps the long view in mind and that keeps the common good in mind? I think that's the most important challenge. One thing I love about economics as a subject matter, and which is why I'm sort of very passionate about it, is that it makes it clear, using sort of the arguments that I just tried to make, some of them, it makes this very clear that ultimately we are all in this together. And so the extent to which we can come up with norms and laws and institutions that keep the common good front and center, and institute policies that prevent us from going into this direction of myopic decision making that leads to these negative externalities and things of that nature, that we will all, as a society, as a community, as a country, we will all be better off as a result of that. Now, coming to that conclusion, coming to that viewpoint, of course, requires a certain level of maturity from the leadership, from the society, from the institutions, from the elite, whatever you want to call it. I see part of our role as just keep hammering these things so that enough people realize it, they understand it. As this is partly the reason, Ellie, that I mentioned in the beginning, that I take some of this blame, that while of course there is corruption, of course there is rent seeking, of course there are bad incentives, there is still an appreciable amount of problem is lack of communication on the importance of these issues and the importance of these problems. So I think if we continue to talk about them in the right forums, if we continue to push for the right set of policies for the right reason, I think it becomes harder for the other side to make the claim that no, we should still go for the bad policies because of some excuse XYZ. I think that's where we need to be very clear. Say, no, this excuse XYZ is wrong, and here's the science, here's the data. This is what I like about empirical work, empirical evidence, that it's very hard to deny empirical evidence. So it perhaps, if nothing else, it makes it more apparent that somebody is pushing a certain policy because of, not so good reasons or incentives, perhaps.
There's a question from Anela. It sounds like you talk about risk sharing just domestically, but you also talk about FDI, which is also equity. So would that be a form of risk sharing across borders? Would it play that role?
Absolutely. Absolutely. I mean, I think risk sharing, everything I said, obviously, because we were talking about emerging markets, I largely focused on from an emerging market kind of domestic perspective, if you will. But even when I for example, when we talk about flexible exchange rate and not borrowing in a foreign currency, those two things combined together, you borrow in your own currency and you have a flexible exchange rate. The reason it tends to be a very good decision on the margin, again, it's not sufficient, but it tends to be a good decision on the margin, is precisely that it leads to better risk sharing internationally in a global context. So that's why it's so important. I would say, by and large, the three things that matter in this international context is, flexible exchange rate, borrowing in your own currency, and then prioritizing productive over non-productive credit in an international context as well. I think those three things are, they are sort of good building blocks of a good set of policies by and large. On this last point, and I thought I may have some time into it, but then Ozer also told me that my co-author Ludwig Straub has presented to some of you this recent paper of ours, Indebted Demand, so it's okay that I didn't have time to talk about it. But I just want to say one thing, that in terms of this international risk sharing and holding non-productive credit at bay, one structural problem that the global economy is facing is this rise of saving gluts around the world. So everybody's familiar with the global the so-called global savings glut, but there are also internal saving gluts that are generated because of this enormous rise in inequality, rising share of the top 1%, who tend to save at a much higher rate than the rest of the population. So this has created an environment where there's a lot of financial savings available to go somewhere. And the size of those financial savings is much larger than the overall investment, real investment being made in the economy. So there is this gap between available financial savings and real investments that are being implemented on the ground. And it is this gap between savings and investment, which is what people refer to as savings, the saving glut one way or the other. Now, it is this saving glut that pushes non-productive credit essentially. And so while I have said, and sort of this localized partial equilibrium sense that you should push back against non-productive credit, there is a bigger elephant in the room, which is this structural saving glut problem. That to solve this issue globally, it's actually not sufficient for the Brazils and the Pakistans of the world to, while they can still, I think, because they are small economies, I think they can still do a lot. But I think collectively there is a global problem. But I didn't have time to talk about this, but there is a very important structural problem of global saving gluts around the world that are financing these non-productive credit booms throughout the world. And that process has not stopped at all, actually. But again, I don't have time to get into that, but that remains a very serious structural problem that needs to be addressed.
There's a question about Korea. What you mentioned China and you mentioned Korea, but what is it that Korea seemed to do right?
I think both China and Korea, the thing that both of those countries have done right, first of all, and then I'll talk about one place where both of them are doing wrong. But the one place where they have done right over a long and sustained period of time is this last point on the slide that you're seeing up there, which is focus on domestic productivity and focus on investing in the people. And it is, I think it's remarkably interesting to go into the details of what the Korean experience was and what the Chinese experience was. And it's really very impressive. I think both of these countries should be very proud of what they have achieved. For all the reasons we just talked about it, it's very difficult to have the wisdom where you take the collective good and so on into account. And I think both of them, they did a good job by and large in focusing on domestic productivity, using finance in the places where they need it the most, and then keeping the bad stuff at bay. Although, of course, famously with the East Asian crisis, Korea learned the hard way, where they had this, again, it was very, very classic boom, right? Dollar-driven real estate boom in the 90s led to problems in Korea. But because they had built so much strength on the domestic productivity side that they were able to recover from it pretty quickly and go back to the trend that they were on. And China kind of avoided that problem for a long time. But So that's the good news. What's the bad news? The bad news is that ultimately they are unable, especially China, they are not able to address a long-term, a slow-moving imbalance that has crept into their financial markets and the broader economy. And this is partly, again, what I was referring to with the saving gluts of the world discussion. And China is an excellent example of that. As I'm sure everyone knows, China has this problem of weak domestic demand relative to the availability of savings, right? Why is that happening in China? Well, it is actually a direct result of poor policy choices in many ways. But this intersects with political economy, so it's going to require a lot of courage, China, to actually be able to overcome it. So let me, it's a deeper conversation. But what is happening in China, if you look at the headline numbers in China, one way to summarize the problem in China is that it's a country that is saving twice. The public saving is very large, and then the private savings is very large. And because it's saving twice, the overall size of that savings is much larger than even though as high as investment is in China, it is still not sufficient to absorb all those savings. This is the fundamental imbalance. Why is China a country that's saving twice? Well, because the public savings are not savings that the households in China consider as their own. Unlike Norway, where they have this social security net and so on, where these sovereign wealth fund and so on, people internalize that as their own savings, and they will ultimately get it through pensions and so on. And so Norwegian household does not save as much because the government is saving for them through oil and so on. In China, that's not the case. It is that gap, the credibility and commitment of that social safety net, for example. I'm just giving you one example of the institutional reasons we have this savings glut in China. Now that requires reform that, as I said, will need some political courage as well. That kind of change, structural change, has not happened in China. And to some extent, that saving glut problem is there in Korea as well. Partly driven by, in both countries, rising inequality. And so I think there are these structural challenges of how to deal with these kind of credibility issues in China and the inequality issue more generally. Those problems are now creating very serious imbalances. And it's probably the most serious question at hand, I would say, for the global economy. And you can see that by looking at the capital markets and credit markets more generally. The size of the financial sector continues to expand because of this savings glut. And the interest rate, the price of that credit, continues to fall. And it has fallen all the way to zero, essentially, in advanced economies. And yet, we haven't achieved a balance. We haven't achieved a balance between savings and investment, essentially. And we continue to have these excess savings. And the only way they can be channeled is by pushing more unproductive debt, either on the household side or more recently, more and more, it's driven through government deficits so that more spending can be done by the government sector. The core issue is this is not sustainable in the long run. And so I think this is the global imbalance that we are facing at this point. It's a Chinese problem, it's a Korean problem, but it is equally an American problem as well. So we, again, didn't have time to talk about this, but we have recent work where we show the existence of this savings glut, which is as large within the US, driven by the rise in inequality, as large as the famous savings glut between US and China, essentially. So I think I'll just sort of, mention again this point of balance being very important globally. And that's a core problem that all of the countries, all of the major economies are essentially facing right now. And this would be sort of, the key element to coordinate on globally.
Moser, questions from Moser.
I think we have passed our allocated time, Ellie. Perhaps one final question.
You're the boss, whatever you tell me.
I feel like we're in a kind of boom, Atif. Your talk has been so interesting. It's easy to be complacent and to just let it go on.
Well, let's try to prevent the crash then, and we can end on a good note.
Atif, while we are on this capital flows and or if you like, when you said when I'm talking about central banking, I mean all these different policies, monetary policy, macroprudential. You might not have views on that, but the integrated policy framework by the IMF and the recent evaluation. What are your views on that, Atif?
Well, I think clearly there's a couple of things. First, there is an implicit admittance of not having perhaps given the best advice in the past, and I think that's a good thing. I think it's always a sign of strength to accept, even if it's implicit in this case, to accept mistake and to improve on whatever the flaws were. So I think it's definitely a move in the right direction. I need to look into all of the details, but my sense is that it's still not sufficient in terms of incorporating all of the various elements that I was referring to here. For example, I think especially the COVID crisis has brought this to the forefront even more. I think we continue to have serious problems with appropriate risk sharing globally. The classic example in my mind, there's so many others, but Greece, in the Greek example, always stands out because this was not a country which is, an emerging market somewhere in a corner of the world that perhaps is politically not that powerful and so on. Greece was a country within European Union, within European zone, among these group of sort of advanced, supposedly sort of, countries that have learned the lessons the hard way in the past. And yet when push came to shove, I think the kind of policies that Greece was forced to go through, it's really incredible in terms of the burdens being imposed on the private citizens of Greece, and as a result, the Greek economy kind of collapsing, and not taking into account the very important lesson that Keynes talked about in his terrific book, The Economic Consequences of the Peace, when he said, don't let these paper entanglements destroy the peace by forcing the local economy. Whatever their past may have been, they may have committed sins, and they did. But don't push so hard on them that the economy collapses. It's bad for them, and it's going to be bad for you in the long run. I think that message, again, as I said earlier, we are all in this together. That message, that's very important. In my mind, that's the most important message of Keynes, by the way, that is often forgotten, unfortunately. And the only thing we remember is the fiscal expansion piece. But this idea that risk sharing is so important globally, what are we doing to go in that direction? I mean, that's the piece that I don't see institutionally. It's a broader conversation, but again, I think there is something beautiful about economics, is to understand those connections, what connects us as humanity more broadly and as a global citizen. And maybe we'll end on that hopefully high note. We need to understand that we are all in this together, that our connections, what connects us really matters. And if we can rise above our kind of more individual priorities at certain points in time and put in place institutions that allow for some sharing of downside risks when things turn out to be bad, or certain politicians may end up making bad decisions, that we don't impose the losses on the average citizen all of the time. I think going in that direction would be not just useful economically, that piece is very clear, but I think it would also lead to a better kind of a global society if we go in with that sort of understanding and realization. But unfortunately, we are far from it right now.
On that wonderful note of all of us being in this together, let me thank you, Atif, for a wonderfully provocative, wonderfully enlightening webinar. Thank you very much, Atif.
Thanks, Ellie, and thanks everyone for being here. It was a pleasure.
Thank you, Atif. Thank you. Stay safe. On that note, we thank everyone for participating us tonight, and see you in our next seminar with Deborah Lucas in November. Thank you very much, everyone, and stay safe.